Hello everyone, welcome to Business School 101. Have you ever wondered what happens when business owners or investors decide it's time to move on? Whether it's a startup looking to sell, a family business planning succession, or a venture capital firm aiming for a return, exit strategies play a critical role in shaping the future of a business. But what exactly are exit strategies, and why are they important? What are the common types of exit strategies, and how do companies choose the right one? In this video, I will discuss these questions with you. Section 1, Definition. An exit strategy is a plan that outlines how a business owner, investor, or key stakeholder will leave or sell their interest in a company. It is a way to minimize risk and maximize value when transitioning out of a business. Exit strategies can be planned for various reasons: personal retirement, achieving financial goals, or responding to market conditions. In the context of management, having a well-defined exit strategy is crucial for long-term business planning, as it determines how and when stakeholders will divest their interests. Section 2, Types. There are several exit strategies that businesses and investors commonly use, each with its own advantages and challenges. Number 1. Acquisition. An acquisition occurs when a company is sold to another business, typically a larger firm. In this scenario, the acquiring company buys out the target firm, allowing the owners or investors to cash out. Acquisitions are a common exit strategy for startups and small businesses looking to scale. The acquiring company may seek to expand its market share, integrate new technology, or eliminate competition. Acquisitions provide an immediate payout but may result in a loss of control for the original owners. Number 2. Initial public offering, IPO. An IPO involves taking a privately held company public by offering its shares on a stock exchange. This allows early investors and founders to sell some or all of their shares to the public. IPOs are often used by high-growth companies to raise capital and allow stakeholders to exit while maintaining partial ownership. While an IPO can result in significant financial gains, it requires rigorous regulatory compliance and exposes the company to market volatility. Number 3. Management buyout, MBO. In a management buyout, the existing management team purchases the company from the current owners. This allows the management team to take control of the business and continue operations with little disruption. MBOs are often favored when the owners want to retire but prefer to keep the company in the hands of a trusted team. However, this strategy requires the management team to secure financing for the buyout, which can be challenging. Number 4. Family succession. For family-owned businesses, succession planning involves passing ownership and control to the next generation. This exit strategy is common in small to mid-sized businesses where maintaining family legacy is important. While family succession ensures continuity, it can also pose challenges in terms of leadership readiness, family dynamics, and potential disputes over ownership. Number 5. Liquidation. Liquidation involves selling off a company's assets and closing the business. This is usually the least favorable option as it often occurs when a company is no longer viable. Owners or investors recover value by selling assets such as property, equipment, or intellectual property. Liquidation is typically seen as a last resort when other exit strategies are not feasible. Section 3, Real-world examples. Let's take a look at how some companies have navigated exit strategies in real-world scenarios. Example 1. Facebook's acquisition of Instagram. In 2012, Instagram's founders decided to sell their rapidly growing photo-sharing app to Facebook for $1 billion. The acquisition exit strategy allowed Instagram's founders to cash out while enabling Facebook to expand its social media portfolio. Instagram continues to thrive under Facebook's ownership, highlighting how acquisitions can provide growth opportunities for both parties. Example 2. Spotify's IPO. In 2018, Spotify went public through a direct listing rather than a traditional IPO, allowing early investors and employees to sell their shares without the company issuing new ones. This exit strategy allowed Spotify to raise capital, increase its visibility, and give investors a path to liquidity. The IPO also demonstrated how companies can go public without diluting ownership through new stock offerings. Example 3. Dell's management buyout. In 2013, Dell's founder, Michael Dell, led a management buyout to take the company private. This exit strategy allowed Dell to regain control of the company, remove it from the scrutiny of public markets, and restructure the business without the pressure of quarterly earnings reports. The MBO enabled Dell to focus on long-term strategic growth while keeping the leadership team intact. Example 4. Ford Motors family succession. Founded by Henry Ford in 1903, Ford's business has stayed under Ford family control for generations. Leadership passed to Henry Ford II after World War II, and today, William Clay Ford Jr., the founder's great-grandson, serves as executive chairman. The Ford family maintains significant influence through special shares, ensuring the company stays connected to its roots while evolving in the competitive automotive industry. Section 4. Factors. Choosing the right exit strategy depends on several factors, including, number 1. Business goals. The long-term goals of the business will shape the exit strategy. If the goal is to scale quickly, an acquisition or IPO might be the best option. For family businesses, succession planning might be the priority. Number 2. Market conditions. The state of the market can influence the timing and type of exit. For example, an IPO may be more attractive during a bull market, while a strategic acquisition might be preferred during economic downturns when valuations are lower. Number 3. Financial health. The financial stability of the company plays a crucial role in determining the best exit strategy. A profitable, growing company may attract potential buyers or investors, while a struggling company may need to consider liquidation or a management buyout. Number 4. Stakeholder objectives. The objectives of key stakeholders, such as founders, investors, and management, must be aligned when deciding on an exit strategy. For example, investors seeking quick returns may push for an acquisition, while founders may prefer maintaining control through an MBO. Section 5. Benefits. Having a well-defined exit strategy offers several benefits. Number 1. Clarity and planning. An exit strategy provides a clear roadmap for when and how business owners or investors will exit, ensuring that decisions are made with long-term goals in mind. Number 2. Maximized value. A carefully planned exit strategy allows owners to maximize the value of their investment or business, whether through an acquisition, IPO, or buyout. Number 3. Risk management. Exit strategies help manage risk by offering a structured way to transition out of the business, reducing uncertainty and ensuring a smoother handover or sale. Number 4. Flexibility. With an exit strategy in place, businesses can be more flexible and responsive to market changes. Having multiple options ensures that owners and investors can choose the best path based on current conditions. Section 6. Summary. In conclusion, exit strategies are a critical part of business management, shaping how business owners, investors, and key stakeholders transition out of their roles or investments. Whether through an acquisition, IPO, management buyout, or family succession, the right exit strategy depends on the specific goals, market conditions, and financial health of the business. By planning ahead and choosing the right strategy, businesses can ensure a smooth transition and maximize value. Alright, that's all for today's topic. If you have any questions or thoughts, feel free to leave a comment below. I hope you found this video insightful. Don't forget to give it a thumbs up and subscribe to our channel. Thanks for watching, and I'll see you next time.